This is episode 12 with entrepreneur and financial advisor Jason Clevlen.
You may know the destination, but do you know the path to take you there? This is Profits to Wealth. We shorten the time it takes for entrepreneurs to find true success through guided conversations alongside industry elites. We'll cover your commonly asked questions and dive into the skills, tactics, and lessons learned from business professionals who've turned the industry on its head through experience, critical thinking, as well as practical money management. It's time to talk business, money, and freedom with your host, Jack Marino Jr.
P.T. Barnum said, "Money is a terrible master, but an excellent servant." Welcome to Profits to Wealth. This is your host, Jack Marino Jr. Today on the show, Jason and I discuss 8 tips to improve your finances. Jason, we're talking about things people can do to improve their finances. We came up with 8 that we'd like to discuss today.
That's right. We came up with a list of 8 simple things that people can do that they can take action on now to start improving their finances.
Simple, but not easy, huh?
That's right.
So what's the first one?
First one on the list is implement a spending plan. We've talked in previous episodes the importance of managing cash flow and having a plan for every dollar that we spend. We actually have a tool that we use with clients, and we've made available for people to download, our Wealth Builder tool. And the goal here is to understand how much you want to spend on various items from your discretionary spending and to try to segregate these dollar amounts.
Yeah, episode 4, we dedicated the whole entire episode to talk about the Wealth Builder tool, how budgets don't work, which is why we came up with the Wealth Builder tool. Spending plan just sounds better than budget.
Right. Once a year, you want to sit down and look at what you're spending on at least once a year, if not more often than that. You want to sit down and look at where are the dollars going. Make sure that, we're setting aside, ultimately that's the goal, right? Make sure we're setting aside the savings that we need and make sure that we're not accumulating any debt.
Yeah, and when you do your Wealth Builder audit, most cases, especially if you're not doing this on a regular basis, you'll find some expenses that you can definitely cut, some services that you're not using any longer that can free up some free cash flow.
Exactly. And the goal is, I think the easiest way to think about this strategy is we're trying to automate our spending or our budget as much as possible. So we want to automate savings and spending. And so if there's a certain amount that you're going to allow yourself to spend on discretionary items like dining out or other entertainment or, various things that we have some control over, it really works well if we can isolate those expenses to maybe one checking account. And then we fund into that account monthly the dollar amount that we want to spend. And then we can just monitor that one account and make sure that we, stay within the spending constraints that we set. And then, that way our vision doesn't get blurred as we're looking across our finances to determine, how are we doing throughout the month? Because we've kind of separated everything out and we just have to keep an eye on this one account, for our discretionary spending. And we've set up everything else so that bills are automatically being paid from other accounts. Savings are automatically occurring. Everything is running smoothly.
Yeah, so essentially the reason why I think this is a more simple, easier to maintain system is because of what you said, is that you're automating your savings, but your normal mandatory expenses are all automated as well, and they all are deducted from, let's call it account A. That account doesn't get touched from a standpoint of a debit card, a checking account, or checkbook. So all your bills are paid, and then your account B, if you want to call it the fund money, that's really the only one that you have to manage. And so instead of taking and micromanaging every category within your quote unquote budget, which can take a lot of time and maintenance, this is really simple.
That's right. It gives instant feedback. You can much more easily look at your accounts and know if you're doing okay throughout the month or not. Whereas if everything is lumped into one account and you're spending and saving and paying bills from one checking account, it may be more difficult to determine if you have enough money in there to make it to the end of the month, or if there's excess dollars in there that you could move out and save. And by segregating some of this stuff into multiple accounts, you get a much more clear picture.
So we'll definitely put a link in the show notes to the Wealth Builder tool. It's a free download for anyone interested in that. And if the Wealth Builder doesn't work for you, maybe you have another system or some type of technology tool that you like. The point is that you're actually reviewing those numbers, your cash flow, and looking for ways to improve and increase savings. So what's the second one?
Number 2 on our list was maintain an adequate cash reserve. And, cash reserve is important because that's your emergency fund or your rainy day fund. And we want to make sure we have enough cash available in case, those unexpected events happen or, unexpected expenses occur. We need to have enough, liquid cash available to us to get through, those various expenses or those times. If a spouse loses a job, making sure we've got enough money there to, get through those months. So we want to make sure there is adequate cash on hand. And that's something else that we need to review periodically to make sure that we're in good shape.
So, there's a lot of rule of thumbs out there. You hear anywhere from 3 to 6 months. Obviously, each person's situation is different. And there's some situations where they need much more than 6 months. But, since we're talking in general terms, we landed on 6 months. So take all of your expenses, add them up, multiply it by 6, and that's a good figure that you might need to have sitting in some type of cash account.
Right. That's a good starting point. And if you went through the Wealth Builder tool and just worked on your spending plan, then you should have a pretty good handle for what, the monthly cash outflow is looking like. And so if you can determine what you're spending, what's going toward expenses and debt payments, and like you said, take that number each month and then multiply it by 6, that gives you a good target for a cash reserve.
Right. We're not suggesting that you have 6 months of expenses in a checking account, because most checking accounts may pay you 0.10% APY. Very low. At the end of the day, yes, the number one most important thing there is to have the right amount. And let's say in this case, the 6 months, but then we want to actually use some high yield savings to generate a higher rate of return on that cash. So it's just at least hopefully keeping up with, it's hard to do nowadays. Let's say inflation is 2.75 on average. I know we can't get 2.75 yield on our savings account, but we can get something close.
Yeah, there's a lot of savings accounts that are FDIC insured that people can set up online with a number of different financial institutions. And I think that's the important thing is if you're looking at these high yield savings accounts, make sure it's FDIC insured so you at least have that layer of protection, and you can get, as we speak today, close to 2% interest rate on some of these online savings accounts, give or take a little bit, and compare that to the local big bank checking and savings accounts. Most of those are making 0.1% at best. So you can get easily 10 to 20 times the amount of interest by setting up these online savings accounts. And another benefit is it makes it a little more out of sight, out of mind.
Right. And so the other part of this is, let's say you went through your Wealth Builder or cash flow tool and you came up with, let's just throw out a number, with 60 grand. And in the event that maybe you have 100,000 in cash, we would definitely ask that client, if they were a client of ours, if they didn't have any short-term needs for that they were accumulating excess cash, we would ask them to put that to work towards a different goal.
That's a good point. Yeah, you can certainly have too much cash because that becomes, a misallocation of capital. That money could be working harder for you if it were invested in a different account. And so if you have the cash reserve goal met, and we encourage clients to set up automatic contributions to these savings accounts to maintain them in case we have to dip into them throughout the year for various expenses that come up. And if we get to the end of the year and we go through and do an assessment and we determine the cash levels have accumulated above our cash reserve target, well, that's an opportunity to sweep out that excess cash and put it toward their retirement goal or their children's education goal. I mean, there's somewhere better that we can invest that money and put it to work.
Right, because then we get into the conversation of opportunity cost, which is, let's say if you earn 2% in, let's say, your FDIC insured investment or high yield savings account versus, I don't know what figure you want to use in the markets, but let's just use not 30%, but let's use maybe 8, on average, or even 10, right? So 10 in the market versus 2 in my high yield savings. So the difference there is 8 or 6, depending on what rate of return you were looking at on the investments. So the difference is your opportunity cost. So to your point, having excess cash may not seem that big of an issue, but longer term, it can really add up, that opportunity cost of having that excess cash.
Oh yeah, tremendously. I mean, big difference between making 1 or 2% on a cash account versus 8 to 10 on an investment account, especially over time once you compound it out.
Right. So far we've talked about, we're kind of building here. The basics is the Wealth Builder. That's our tool to help our clients with their spending plan. So the first thing is a spending plan or cash flow, maintaining your cash flow, managing your cash flow. Second is having an adequate cash reserve. What's the third?
So the next one on the list is to increase the amount that you save and invest annually. In other words, don't get comfortable with the amount that you're contributing to the various savings and investment accounts. You need to have some date throughout the year, every year, where you sit down and you take a look at it. I think, the beginning of the year is a great time to do this, and you increase your savings. You notch up the amount you're contributing to maybe your 401k, or you increase the amount you're putting into, your son or daughter's 529 plan. Or if you have a brokerage account that you're investing in, bump it up from $500 a month to $600 a month. If we continuously do that every year, it makes a huge difference over the long haul.
Absolutely. And, let's say we're in 2020 as we record this, there's a lot of different ways that you can contribute towards retirement plans, let's say, and not only help your cash flow from a standpoint of potentially reducing your taxes, right? But we have a lot of different type of retirement plans. And 2020 plan limits, let's say, for example, we have a 401k, which has a $19,500 plan limit, contribution limit on the pre-tax or Roth. And then we have IRA and Roth, which is still $6,000, just like it was last year.
Yep.
SEP limit, $57,000. The simple IRA is at $13,500, and none of these are with the catch-up provision. Obviously, you'd want to talk with your tax advisor or financial planner, whoever you're working with, to see which one, if you don't have a retirement plan, which one you should set up, and then how much you should contribute, because just because you can contribute doesn't mean that you should.
Right. And as you said, if someone's over 50, there could be some opportunity to do additional catch-up contributions there. I think maximizing retirement plan contributions every year is a great goal. That's not always necessarily the best strategy, but a lot of the times it might be. So that's certainly something that we're looking at with clients to figure out what opportunities are there to help them maximize their current tax situation as well as plan for the future. And on that note, there may be opportunities if they have a 401k to make additional after-tax contributions once they've, reached that normal deferral limit of $19,500. Some plans will allow them to put additional money in. I think we talked about that in the previous episode. And those after-tax dollars can be converted into Roth IRA accounts. So there's another opportunity where if a person is looking for where else can I save some dollars, that may be a way to do it.
Yes, and what I was saying about just because you can doesn't mean you should, just means that the second item we talked about, which was cash, if let's say, for example, you had $6,000 in cash and you were thinking about doing an IRA contribution of $6,000, you could, right, contribute the $6,000, reduce your taxable income for tax year 2020, but then now your cash, you don't have liquidity because it's all in the retirement plan.
Right.
So you have to take everything that you do in context of all the other moving parts of your financial plan, and especially if you're a business owner, because not only we're just talking about personal finance here, on the business side, obviously the business has its own reserves as well. So everything we're talking about is should be taken into context with everything else. And obviously, like we've said, need to talk to your tax advisor and planner.
Right. And then, while we're on the topic of investment accounts, if we're increasing contributions to various investment accounts, we should also be taking a look and seeing if we need to do any rebalancing of the portfolio. It's a good idea to do an annual rebalance. And I say rebalance that, we should have some target investment allocation that we're trying to maintain particular risk level. And as time goes on, that balance gets out of whack. We need to rebalance the portfolio. And so at least annually, we like to rebalance, especially retirement accounts, but really any portfolio. And then another opportunity for rebalancing is if we get some volatility in the markets, anytime you see stocks, for example, go down by 10% or more, that's what we call a correction. That's also oftentimes a great time to go in and do a rebalance. Rebalancing portfolios is a way to force yourself to sell high and buy low, because that's what's going to happen in the rebalance. The assets that have done really well, you're going to take some profits on. You're going to move those proceeds into some of the asset classes that haven't been performing as well. So you're selling high, buying low. Really good strategy.
Absolutely. That's a good bit of advice there. So what's the next one?
So number 4 on our list was focus on debt reduction. And there's a number of things here, that a person can do. And I think the main idea is we just want to make sure that we're taking a look at the debt that we have year over year, and let's make sure that that's trending down. Ultimately, we all want to get to a point where we're debt free. So we want to make sure that we've got habits and systems in place that are going to make sure that that happens.
Yeah. And on debt reduction, this one is really important. And we didn't necessarily put them in order that we usually look at them because, as I mentioned before, I don't want to beat the dead horse, but if debt was a larger concern, maybe you're paying higher interest rates on maybe some consumer debt, making retirement plan contributions may not be the best move that you could make in the short term, at least. Wouldn't you agree?
Yeah, I think maybe under that scenario, you might put enough money into a retirement plan to benefit from any employer matching dollars. And then beyond that, you may focus on getting that. If you have high interest consumer debt, you definitely want to focus on getting that paid off. Ideally, we don't have any credit card debt would be the ideal scenario to be in. And so we want to go through and look at, the various types of debt that we have and see, are there any opportunities to refinance to lower rates? If we can get a debt refinanced to a lower rate, and if we continue paying the same amount of dollars towards that loan, it's going to get paid off faster because there's less interest accruing on it. And so some things that sometimes people forget to look at when it comes to refinancing, one of them is their auto loan, car loans. If interest rates drop, there's opportunities to refinance auto loans. You can go to the local bank or credit union and refinance that and expedite the time it takes to pay off your car loan. And that could be a $600 or even $1,000 a month payment. And if you can knock the interest rate down and even knock a payment or two off on the loan term, well, that's a couple $1,000 in your pocket at the end of the term.
Yes. It doesn't cost anything to do that either. Although we should point out, we're not advocating extending the term, meaning that if you had 48 months left, we're not suggesting that you go to back to a 60 month, right?
Right. So yeah, if you kept that payment the same, so if you're paying $800 a month now towards your car payment and you go and refinance it and they drop the rate from 3% down to 2% for you, And if you continue paying the same $800 a month, well, then that's going to get paid off faster. It's not going to extend the loan. So yeah, we don't want to keep extending auto loans. We want to get those things paid off.
And then outside of the auto loans, of course, the bigger loan that typically everyone has is a mortgage. And there, as long as clients aren't looking to move anytime soon, and that because we have to run a break even if each time we do a refinance to find out how long they have to stay in the house to make it worthwhile, because there are costs in refinancing a mortgage. So you just have to be cautious of that and to consider the future on that. But huge savings moving to a lower interest rate. And there still are folks that we run into that definitely need to refinance their mortgage. Maybe it's not the mortgage, it's home equity loan.
Yeah, I think on the mortgages, if you look at the interest rate that a person is paying and what they are refinancing into, sometimes there's an opportunity to do what's called a zero cost refinance. And generally what that means is you're taking an interest rate that's slightly above the going rate in the market. And for doing that, you get a credit. And that credit can be applied toward covering the closing cost. And if you do the refinance that way, you're saving instantly on the refinance of the loan. Sometimes people will get a lower rate and there'll be some costs that get rolled into the loan. And so it seems like you're not coming out of pocket for anything, but it's actually increasing the amount of mortgage that you have. And so then if you do it that way, there is a break-even period where it takes a little while for the interest that you're saving on that mortgage refinance to offset that additional cost that was incurred by rolling in the refinancing expenses into the mortgage. But if the option is there to do the zero cost where, you get the credit, that really is a good way to do it because you're saving instantly. If you end up moving a year later,
doesn't matter.
You still won. And then the other thing that's nice is, let's say interest rates suddenly go even lower. You can just refinance again. You're not out anything for that initial refinance.
Yeah, good point.
So anyway, that's something we often help clients look at is options for refinancing their mortgage, and when should they go from a 30-year down to a 15, and looking at cash flow and seeing what all matches up for their situation. But yeah, home equity loans is the next one on the list. And sometimes it makes sense to consolidate other debts into home equity loans. We often see, home equity loans used for consolidating, high interest rate consumer loans into a low interest rate loan that's attached to the house. The danger there is that we don't fix the underlying problem that caused the consumer debt in the first place. And if we don't fix that initial cash flow issue, then that person's going to end right back up with new credit card debt, except they're not going to have a home equity loan to bail them out this time around. And then they're going to have even more debt than before. So if it's done correctly, a home equity loan can be a good way to move some higher interest rate debt onto a lower interest rate loan. But that is something to be careful of.
And then you have credit cards, right? Themselves. And then to your point, maybe you are able to roll those in a home equity loan, but maybe there's not a whole lot there. In this case, it could be that we're going to transfer to a zero balance and accelerate payments and pay that off in that 18 months or whatever the term for the zero is. So it's really good to review your credit cards. Obviously, we want to make sure we're paying them off on a month-to-month basis if you're using them for points or perks or travel rewards. But if you're not and you do have a balance there, we definitely want to transfer that to a lower rate because interest rates on credit cards are extremely high. They can be, low teens all the way up to 20, 30%. So definitely want to make sure that we're managing that. And then, of course, we have student loans. So on the student loan side, there's a lot of nuances on refinancing student loans. We're not going to get into that today because it really depends on your situation. But looking at, do you need to consolidate your government student loans? Should they be consolidated or refinanced? There's private institutions that have private loans. and should those be refinanced? So there are pros and cons on refinancing government student loan debt to the private side, which we see a lot of the time does happen, but there are some nuances related to debt forgiveness, student loan forgiveness that you really need to be aware of if you qualify. And of course, there's a lot of talk of expanding that. So you do have to be careful when refinancing your student loans.
Yeah, good to get some guidance on that as someone explores their options for how to lower the rate on student loans. And when we're thinking about all these, for someone who has multiple debts and is aspiring to become debt-free, I think a really good strategy to paying down debt and to really building some momentum is to tackle the smallest balances first. We call that a snowball strategy, or I guess that's what the strategy is often called, is a snowball strategy. And so you start with these small loans, you pay them off, you're building momentum because you check that one off the list. And once it's paid off, you take the payment that was going toward that loan and you add it on to the next biggest debt that you have. So now there's a larger payment going to that loan. You're still, your total cash outflow is unchanged. You're still putting the same amount towards your total debt pay down. And you're just building momentum towards paying these debts off. And if you have a couple debts that are of similar size, then of course you should tackle the one with the higher interest rate first. But that's a really good way to build some momentum and to feel like, we're making progress towards the debt pay down.
Yeah, it's not necessarily the best logical way to do it, right? Because logically you would pay the highest interest rate first, but we're talking about ways to get a little bit of momentum going from a psychological standpoint. Right. It's nice to pay that little balance off first because you're like instant gratification that, hey, I've paid something off. I instantly have less debt, and you don't necessarily really see the interest rate, kind of racking up unless you're really tracking that closely. You do track, how much debt you have and is it declining or not. So
that's right. Yeah, the math shows if you pay the highest interest rate first, that's a more mathematically efficient way to do it. But from the psychological standpoint, making progress really helps us stick with the program.
Absolutely. So what's number 5?
So the next thing on our list is to annually review your financial goals and track progress. And so, when we think about the financial goals that we have, retirement, could be education goal for kids, could be, saving up for a down payment on a house, whatever other miscellaneous goals we have, it's really good practice to take a look at those goals and see, year over year, are we making progress towards them? Are we on track or not with the amount that we're saving and the performance of our investments? Do we need to make any changes to the various goals that we have? Maybe we've decided we have some different plans for retirement, or maybe we've had a new child and we need to add some additional education goals to consider there. And so we've got to, constantly be evaluating what our goals are and making sure that we're on track. That way we can make any adjustments to our plan or strategy. If our investments have a bad year, that could mean we need to increase our contribution a little bit to make up for it. Or if, the market's doing really well and maybe we're on track and things are sailing along smoothly and we're even headed toward achieving our goals sooner than expected.
Or the child wants to go to, it was University of Texas and now it's Duke University.
Right. There may be a little more there that you need to put away.
A little different and that obviously will play a role in your retirement goal. If you're taking away funds that were directed towards another goal to apply it towards something else, obviously taking into context your entire financial situation could have other ramifications that you need to look at and potentially even change the investments.
Right. If you were originally thinking, in-state college for your kids, and then suddenly the goal has shifted to some out-of-state school, depending on what type of plan you set up to save into, the Texas Tomorrow Fund is for example, a prepaid tuition plan, and it's really geared toward Texas schools. And so if suddenly you're planning for an out-of-state school, then that plan isn't going to be the most beneficial option for you. So you might have to consider another type of account or, different 529 plan. So just constantly, we want to revisit our strategy and make sure, any previous strategy that we put in place, let's make sure it still makes sense for whatever the goals are.
That's great. Great advice. So we're on to number 6.
So annually, we should be reviewing our insurance coverages and our needs. And there's a variety of different types of insurance that we should be, periodically looking at. And, these are not the funnest things to look at and to review, but definitely important. And if we're going to have a solid financial plan in place, then, reviewing these insurances is important, something that we have to look at. And you can start with auto and home and umbrella coverages. And I think, it's just important to make sure you have the right amount of coverages in place. And, every couple of years, often it's a good idea to shop those around and see if you can save some money on premiums.
Yeah, definitely. Once a year, we advise to review coverages, overall coverages, and then every 2 years or so is depending on if you had accidents or not. But then you can go ahead and shop those to the different carriers, because what we found is a lot of times carrier A, your original carrier, will be cheaper, and then all of a sudden maybe they had a lot of claims or too much exposure in an area, and they'll raise premiums on you, and then you have to sort of switch to another insurance company.
Right. Definitely no harm in shopping around and just seeing what's out there. If you find you've got really good rates, then there's no reason to make a change, then fantastic.
Right. It could be $1,000 or more a year, sometimes.
Oh, yeah.
Savings, Yeah.
So,
and then you have life insurance, which is never fun to talk about life insurance, but most cases, if you have a life insurance need, which most people do, unless they have a huge nest egg already saved up, we're really insuring our income there. And the question there is, how much do you have? How much do you need? What type? Have there? And one that I think most people don't think about is maybe health changes or improvements. So, for example, maybe you used to smoke. And if you used to smoke and you don't anymore over a period of time, you can actually either get a new policy, go back through underwriting, or you can call that insurance company and ask for a review. Maybe they'll adjust the premiums down.
Right. Same thing for weight loss. If a person has lost weight and kept it off for a period of time, there could be an opportunity there to reapply, get some new coverage at a lower cost per month. And same thing goes for disability insurance and long-term care insurance. It's important, with disability insurance, the idea there is if you become sick or injured where you can't continue earning an income, that there's going to be some policy that could step in and continue paying, some income to the household so that you can maintain some level of lifestyle. And so the goal there is to look at what would the scenario be like if you lost your ability to earn an income? What need might there be? A lot of employers offer some base level of coverage for disability insurance. And if that's not enough, there's some options to get supplemental coverages. And then on long-term care insurance, that's assisted living type insurance to help pay for nursing home or home care. And so that can become very costly later on in life. And so it's something that we need to think about and at least have a plan for how are we going to pay those. And so annually, it's a good idea just to walk through these different types of coverages and reassess, do I still need this? What would happen under these scenarios? Do I have the right amounts? Do I have the right types?
Excellent. Yeah. And you should seek help from a professional on this, because the amounts and types can get pretty complex. So you should seek somebody that your planner, insurance agent. So what is number 7?
So number 7, let's talk about maximizing the tax benefits of your charitable giving. And so, when we think about charitable giving, we have a lot of clients that they save a certain amount, or they give a certain amount every year. And, if you're giving to a qualified charitable organization, you're going to get a tax deduction for that already, up to certain amounts that you can give, based on your income. And there are some additional things that we can do to be even more tax efficient. And one of those that often gets overlooked is rather than donating cash, we can actually donate highly appreciated securities. Most charitable organizations will gladly accept those, maybe highly appreciated stock investments that we have. They'll sell them right away and use the proceeds to help fund whatever operations that they have. And the charity doesn't have to pay any tax on obviously receiving that gift, or they don't have to pay any tax on the gain. And the benefit to the person who donated the securities is they don't have to pay tax on the gain that stock had either. So if they had made an investment in a company for $1,000 and that investment over the years had grown to $10,000, and if they normally give $10,000 anyway, they could just give that stock, not have to pay tax on that gain, and rather than giving their $10,000 of cash, if they really liked that company, they could take their $10,000 and go back and buy that stock again and essentially reset their cost basis.
Absolutely. The only difference would be is the how much you could deduct in a single year, cash versus security. I believe it's 60% adjusted gross income on cash, don't quote me, and 30% on securities. But yeah, to your point, huge. I mean, just in the last year, Apple's up over 100%. So, you have a lot of clients, people out there with highly appreciated stock that they're inclined to give anyway. They might as well look at what securities in a taxable account. We're not talking about obviously IRAs, but taxable account, they might as well use as an opportunity to reset their basis. Okay, then we have, donor advised funds, which we don't, usually talk a lot about, but that is another way. It's similar to a foundation, if you will, but it's much easier and cost effective to actually do. So, for example, let's say you had a year where you had a really big income, a sale of a business or something, a scenario, and you wanted to donate a large amount of money, for example, and you didn't want to donate, this would be in the event where you didn't want to donate all that in the same year to the charity or to charities. You could set up what's called a donor advised fund, make the contribution, receive the tax benefits of that today, and then you get to decide with your family how that gets distributed when over a period of time.
Right. Plus any additional growth that accumulates possibly in that donor advised fund, it can be invested while it's waiting to be given.
Yeah, you can invest it however you want to. Obviously you should consult a tax advisor before implementing anything like this, but I mean, these general ideas work very well, and you should definitely explore whether these make sense for you. So we're on to 8. What's number 8?
So the next one is let's fund your HSA account. If you have an insurance plan that allows for an HSA account,
health savings account, right?
Right. Health savings account. Thank you. That's a great tool to use to help pay for medical expenses with pre-tax dollars. So if you put money into your HSA account, you get essentially a tax deduction, and you don't have to pay tax on that amount that was contributed. So for 2020, an individual can put up to $3,550. A family can do $7,100. And so that's instant tax savings by making those contributions. And you can actually make contributions for the prior tax year up until April 15th.
Yeah, so you still have time to contribute. And the beauty of a health savings account is that it's not a use it, lose it like a flexible spending account, because those you do have to use by the end of the year. At some point in your life, you're going to use the funds for health reasons. No matter how old you are now, you will use them. So these are great plans.
Right. And I would encourage people to set up, an automated monthly contribution to fund their HSA account. If you can make the maximum contribution, fantastic. If not, at least get something going in to build that up so that you have that medical, rainy day fund ready to go.
The other thing I think it's not as widely known is the one-time rollover. So let's say you had an event where you've got to have a surgery, a procedure, large amount, you don't have the balance in your health savings account, don't necessarily have the liquidity to fund it, you could do a one-time transfer from your IRA to the health savings account to fund that without taxes or penalties.
Yeah, that's a really slick way to get some dollars from a retirement account to help funding, some potential medical expenses, like you said, without having to pay any taxes. Because normally that money comes out of a IRA to help cover medical expenses. You at least have to pay income tax on it. There are some rules that will help you avoid a 10% early withdrawal penalty, but you still have to pay income tax unless you do this little rollover trick that you're talking about.
So I think these 8 tips that we talked about today are very beneficial, and they're, I'm sure, no matter where you're at financially, something that we talked about today hopefully will be beneficial to you. But before we depart, what's your tip of the week?
So tip of the week this week, I think let's stick on the HSA topic. If you can focus on building up your HSA over time, let's say, maybe your health is very good and you're not spending a whole lot on medical expenses, so that balance is building up. One of the things that would allow a person to do is eventually they can change the type of health insurance plan they have. And more specifically, they could increase the deductible on their health insurance plan. So maybe someone's in a health insurance plan where they have a $2,500 deductible. And after a couple years, maybe they haven't had any issues, haven't had to go to the doctor much, but they've been putting in a couple $100 a month to their HSA, and now it's over $5,000 that's in their HSA account. Well, they could switch their insurance plan when the next year rolls around and increase the deductible on their plan from $2,500 up to a $5,000 deductible. And so by increasing the deductible, they actually lower their insurance premiums. So they're going to save some money. And if something does happen, they've already accumulated all the money they need to cover that deductible in the HSA account. So if we can think ahead, accumulate some dollars in that HSA account, it can allow us to actually save some money on our medical insurance premiums in the future.
Yeah, then if something did happen, they zeroed the account out, for example, you could always, during the next open enrollment period, change to a different plan, a lower deductible plan if you wanted.
That's right. You could go back down to the $2,500 deductible and start the process all over again.
I love it. So questions, I just want to remind our listeners before we end today that we are still looking for more questions. We get them. We're about to do a show pretty soon on questions that we get. So if you have any questions for Jason, myself, or any of the prior guests that we've had on Profits to Wealth, head over to profitstowealth.com/contact and submit your questions there. Jason, thank you very much for your time. It's always fun and insightful. And I'm looking forward to the next show.
You got it, Jack. Can't wait for the next one.
Take care.
That's all for this episode of Profits to Wealth. But we have more resources available to you on our website. Head over to profitstowealth.com and take our questionnaire to find out how we can provide you with a tailored approach to your entrepreneurial journey. It's available exclusively on profitstowealth.com. Until next time, we look forward to talking business, money, and freedom right here on Profits to Wealth.